Hey everybody, it's Pete. Good morning and welcome to a new episode of Stocks for Breakfast. Today we're going to talk about something interesting, which is really where trading conviction comes from. Quite a few people feel that trading conviction comes from finding the best entry price, but that's not really the case. Trading conviction comes from the idea itself. So what we're going to take a look at today is price action, how to put the pieces of price action together so that when you look at a chart, like that, you can say, that looks really good versus, why would I do that? There's really nothing going on there. So we're going to take a look at what are the building blocks of forming a good idea. And we're going to talk about the two main components of that, two probably the most popular ones. One that I'm really pretty well known for, which is order flow, which is the bigger picture. And the second part is momentum. And momentum trading has kind of been around forever. So we're going to take a look at how momentum interacts with order flow and how those two things combine to give you conviction, where you can look at a chart, look at a trade and say, you know what, I really feel like this is a good idea. And when you allocate money to that, you feel comfortable that you say, if I do this more often than not, I'm going to make money. And this is what we do every day in the boot camp. This is what we talk about every day, so to speak, here in the channel. If you find these videos helpful, definitely click down and subscribe. That would be awesome. I'd appreciate that. And if you want to trade together for the next 30 days, learn about the boot camp too. I think you'll find it to be an amazing investment. So we're going to head over to a very short presentation, and then we're going to go over to the charts to look at to look at exact real examples of what we're about to learn. So first, we're going to start out with momentum within order flow. So you can see this is just one individual candlestick, and then as price action from day to day and week to week starts to unfold, the picture starts to get clear and it starts to give you an idea of what's a good idea, what's not a good idea. But I think what's important as this starts to unfold is you need to understand when the picture looks good, when the picture is changing, which is the beginning, the foundation of tape reading, and then more importantly, what should happen next. If what you see, let's go back, if that still looks perfect and then something like that happens, what does that mean for you as a trader? What does that mean for you as somebody managing risk, managing profits, and how you manage those positions? Do you add? Is that pause a situation where you look to add to the trade? Is that pause someplace that you just get out because something changed? Is that pause a place where you scale out? Is that pause a place where you move a trailing stop? You need to understand that. But what we're going to discuss next is kind of interesting. This is what the price action looks like, but we want to take a look at if the price action looks a certain way, what's probably happening with the smart money. And then within the smart money, how do we know when that situation changes so that we know as traders, what are we supposed to do next? So you have order flow, momentum, a change of order flow, new momentum, and then a possible change in order flow and momentum back in the direction. So it's kind of cool where you should be able to look like that, bam, and know exactly what's going on. So we're actually going to talk about what's happening under the hood, then go to some real charts so you can get a really clear example of what's going on. So first and foremost, we want to talk about something that's known as accumulation. Now, accumulation and distribution technically happens when price is not moving. That's a big thing you want to write down. Accumulation and distribution is when volume increases without price action moving. That's a big deal. So accumulation is where institutions, or now what we know as the smart money and hedge funds, are buying shares as quietly as possible as price moves lower in a downtrend. Now that's the big part there, price moves lower. Now they're buying it as quietly as possible, which means that price is not moving that much. That's a big part. This will be buying ending a downtrend, leading to a consolidation or a pullback. They're beginning to accumulate a position. So that's where the word accumulation comes from. But the biggest thing you want to take out of this slide right now, this part of the training, is that it's after a downtrend. It's after prices have moved to the downside. It could be for a couple of months. It could be for a couple of years. But the important thing here is as it's going down, price kind of starts to trade sideways a little bit. Volatility gets smaller, but volume increases. That's the big thing that matters here. So most traders who are watching this are seeing it go down. So they're short selling it or exiting because price is going down. But since it's going down, it will be easy for the smart money to build a position because I'm sure you heard this on television where you're watching somebody saying, I like it at that price. Well, that's the price where they're starting to build that position because that price is a price where they think some point in the near future it's going to be higher. So they start to get a position and build a position in that area. So what happens next? Accumulation and action. When an institution has a large order to fill, now that's the important part there too, where a lot of traders make the mistake where they use, bam, they jump in with, they want 1,000 shares and bam, they jump in with 1,000 shares. Smart money doesn't do that. So as traders, as individual traders looking to take money out of the market on a regular basis, we should also be looking to work our orders the same way that institutions do. And we've been talking about this a little bit recently, especially heavily in the boot camp. And some of the new traders that have been in there that are starting to grasp and that's not the right word. Accept the fact that it's easier to trade when you're not going in with full size, and you make the market give you feedback before you start to add. Trading becomes a lot less stressful. So they try to do it as quietly as possible in pieces. The reason for wanting to do it quietly is simple. If you just start buying 1 million shares and start buying 1 million shares, it's going to go up on yourself. So if you really like the stock, you don't want to do that. So what ends up happening is they will passively buy as many shares as possible, which means they're advertising to buy. They're not aggressively going out and buy it. As it's going down, they're just saying, okay, I'll buy them, I'll buy them, I'll buy them, until the selling dries up. If they need more, they'll need to start paying higher prices. And I just showed you how to see that on the chart. We'll get to that in a minute. So it can be seen on a chart as a pause in a pullback. So a pause with heavier than normal volume after a downtrend. That's the whole main part here. So now you need to start adding two different things to your charts. The price action itself and the volume and where it happens. So very, very simple, easy to understand. So what happens next? Now you're a hedge fund, you have millions and millions of shares to buy, you started to accumulate, but now prices have stopped going down, so you can't be quiet about it anymore. Now you have urgency. Now you have to start stepping up and saying, I need more stock. So now the large buyer in need of more shares must start to pay higher prices to get the shares on that they want before it starts to move in the direction that they believe prices will go. So the pause that was formed by the buyer, where it started going down and now started going sideways, has caused many traders who were selling to stop, because now it's no longer going down, right? Just good, pure tape reading, right? So we now have two groups of traders who need to buy stock. Those who sold the stock short, believing it's going to go down, they have to buy it back to get out of it. And the large buyer who needs stock. So now you have two different people that want to buy stock and they have urgency. What do you think is going to happen next, right? The only logical thing that can happen now is that prices begin to rise. And this is what we talk about with well bid and well offered on the charts. You can see it going down. It's well offered. There's still urgency and it's going down. All of a sudden it stops going down. We have indecision candlesticks or a pause for a few days, weeks even. And if that pause happens on higher volume and the big money still needs the shares, they start to have to pay higher prices. And that's what we know as the markup. Excuse me. Demand eventually overtakes supply, and the price action begins to break out of the pause with larger volume traded in the direction of the breakout. So again, super simple. If it's going higher and you have larger volume, that's good. There's demand from the smart money. The markup starts with what are larger green energy type candlesticks with big volume. So very simple, right? Large green candlesticks breaking out of a pause with large volume. Very, very simple. An urgency to acquire shares has arrived. This markup is also what we know as an uptrend. So what we're talking about now is what's actually happening and why it's happening. Because if you look at the chart, this is why I call it order flow. These are literally millions of shares being sent down to the floor of the exchanges, millions of shares being allocated that are building positions. That's what order flow is. So now you should look at a chart and say, is the order flow obvious? Is somebody accumulating a position? Has a markup started in this stock? So markup with good order flow will be identified by higher highs and higher lows with light volume pauses in between. That has to be, right? We said a heavy volume pause typically means a reversal. Now we're saying a light volume pause typically means continuation. So what happens at the end of that? Distribution, or the end of an uptrend, is what is the opposite of what we just talked about. So if you can imagine stocks are going down, they go sideways with heavy volume, they start to go up with heavy volume, light volume pauses, and now we traveled all the way up. When the large buyer has filled the majority of the order, the markup will typically end with an obvious increase in volume. And we've actually seen this in a few stocks. If you're a regular viewer of my videos, you know that we've called a few stocks out recently where the stock did not move after a significant rally, but volume exploded. That's literally the definition. And we called a couple of really nice short sales, or at the very least, exit your long, right? Exit the position that you bought. For this to be distribution at the end of the markup, there's heavy volume pause. That's very important. A heavy volume pause or a heavy volume, what is known as parabolic move to the upside, also with heavy volume. Typically, you want to look for a heavy volume pause, though. They're a lot easier to anticipate the stock reversing. So what's going on is the large buyer is selling the end of the order while prices are still going up. So they're getting out while it's going up. They're selling to the unsuspecting public. But us, as tape readers, understanding order flow, we're like, oh, something's changing there. It's going up, but now it's going up and pausing on heavy volume. That's not what we want to see. We want to see it going up on heavy volume. We don't want to see it pausing on heavy volume. So after the markup, many shares are trading after a significant new move in upward price action. Can be seen on a chart as a pause with heavier than normal volume. That's the point that we want to get to. So what happens after that? Well, what can only happen after that if the person who is pushing it up in the first place is done, right? At this phase, the smart money, the institutional buying, is slowed down, and the stock is no longer has the demand to support those higher highs, higher lows, that order flow that pushes to the upside. Again, think about when you're looking at a chart. There's order flow. Order flow is what moves the stock. You have to visualize now, is that order flow still obvious, right? Traders sensing the demand has exhausted itself will now begin to test the short side or put trailing stops in the market if it's a profitable position. Traders who bought the stock late, again, traders who are waiting for too much confirmation, and especially somebody who's not smart like you watching this video right now, who's not learning how to read the tape. So because you're learning how to read the tape, you're noticing this. You're saying, okay, it's going sideways, but the volume's super heavy. That's not what I want to see. So these late entrants must now sell to exit their positions, creating urgency. When the previous support levels are broken, these two forces add fuel to the downside, and the markdown starts with the opposite now, which is big energy candlesticks that are red in the opposite direction, and leading to a downtrend in order flow. So we're actually going to take a look now at some charts, and we're going to take a look at price action versus volume. And we're going to start. We're just going to do it on a really high level with the monthly charts, because I really want to mostly have you eyeball the chart really quick. And we'll start out here with the SPY, where you can identify order flow is obvious, right? And we'll just we'll drop in price action there. So you can start to see now when order flow is obvious, when volume increases, volume decreases, and then the sell-off. So what's interesting here is volume, the price action is going higher on decreasing volume, which actually we're seeing right now in the market as well, which is really just confounding people. This is a little bit different price action because it is during the pandemic as I'm filming this, and the market is bouncing with the $2 trillion stimulus package, which is good, fine for the market, but a little bit different type of price action, right? I do want to point out two different stocks, and we're going to go into the, actually, you know what, I want to stick with reading order flow and reading price action in here for a little bit. So what I want you to eyeball very quickly is I want you to be able to eyeball when order flow is bearish and you decide you don't want to do anything because you had bullish, it changed again into bearish, versus you have 5 or 6 months of very clear order flow. Then you have bearish order flow, and then you have super obvious order flow. So it's the situations where order flow is obvious that you should, remember at the very start of the video, I said where confidence comes from, where conviction comes from. Conviction comes from identifying good ideas. When you take a really good idea like Apple and you compare it to something like this, which has been all over the place, quite honestly, this happens to be JP Morgan. Again, nothing wrong with the stock. We're analyzing the stock from an order flow and tape reading perspective. This is where traders lose confidence when they start to trade situations like this or situations like this where it's not obvious, and they start to say, I don't know what I'm doing, or I need to search for another system. Maybe this isn't for me. Trust me, it's not that you don't understand what you're doing. If you understand what I just taught you about order flow and tape reading, it's that you're not paying attention to whether right now is a good situation, and you're losing confidence because you're in the wrong trades, which is why we need to work together, because we call these out in real time. So poor situation, maybe obvious for a few months, definitely obvious for a few months, right? But then this becomes a mess again, and you can't really look here and say, oh gosh, buyers are really in charge, I want to do something. So I want to take this actually to a different level. I want to talk about two different stocks where order flow on the daily charts combined with reading the tape and reading the volume. So you can see clearly here, DraftKings had a really big push to the upside. In this scenario right here, where price action stayed the same for roughly a week and volume increased dramatically, we actually said we're starting to see distribution here because it's a heavy volume pause. And that typically, after a large move to the upside, changes the direction. So we ended up having this 3-week move to the downside. And now as I'm filming this, we're actually seeing something similar in the stock SE, where they actually, excuse me, not SE, STNE, excuse me, STNE, where the last 4 days have seen an increase in volume for what it normally does, but the stock has not advanced. So we're actually looking for the stock to reverse. So a lot of interesting setups going on here, but the main part of what I want to make sure that you get across here is trading conviction comes from knowing what you're looking at. Knowing what you're looking at means you're looking at order flow. Order flow is either obvious or it's not. If it's obvious, then you look to see how long has it been obvious, and that's where conviction comes from. And then when you advance to higher levels, you learn to put those pieces together, and then you learn how to manage what happens between entry and exit. And that's where trading becomes fun, because you're 100% in control of what you do. And that's really where money comes from too. So hope this video helped to give you a little clarity, really, is a big word that I'm really looking for, because when you're looking at it and you know what you're looking at it, there's no reason to be stressed out anymore. There's no reason to be impatient anymore. You can literally just sit back and say, that's not what I want to see, so I'm going to do nothing. So this doesn't matter if you're day trading, swing trading, or longer term position trading. Every time frame has specific charts to look at for that type of swing trade. So whether it's a trade you're looking to hold for a day or 3 days or 10 days or even a couple of months, there's a specific chart to look at that tells you that information and how to read the tape. So hopefully this video helped. If you have some questions, leave the feedback below, and definitely subscribe to the channel. If you'd like to trade together for the next 30 days, definitely click down and look at the boot camp. I'd love to have you in the boot camp as well. Have a great day.